Hello everyone and welcome back. In today's video, we're going to be going over two very common monthly ETFs. That is JEPI, or the JPMorgan Equity Premium Income ETF, and JEPQ, the JPMorgan Nasdaq Premium Income ETF. I am going to call it JEPQ for short. And if you do appreciate the video, be sure to like and subscribe for future content. So I do hold a good amount of JEPI. I do have a little bit more than $11,000 worth of it, and that gives me around 200 shares of JEPI. Now, I think many dividend investors or income investors are curious about which one of these ETFs is better to invest in, whether that be JEPI or JEPQ. And both of these ETFs have similar investment methodologies. They're both kind of designed to provide investors with high income. So JEPI uses disciplined options overlay and implements out of the money S&P 500 call options to generate monthly income. And JEPQ is somewhat similar. It uses disciplined options overlay and writes out of the money Nasdaq 100 call options to distribute monthly income. But there's a very important distinction between what these ETFs hold and their underlying investment metrics. So JEPI uses a defensive equity portfolio and employs a time-tested bottom-up fundamental research process with stock selection based on proprietary risk-adjusted returns. So basically, they invest in a group of stocks that are screened for volatility and use that for their underlying. Now, JEPQ is a little bit different. They do have an underlying equity portfolio, and then they say that there's applied data science approach to fundamental research and portfolio construction. So each one of these ETFs have completely different weightings, and they also have generally different holdings. If you look at JEPE, you could see that all of these holdings are pretty much weighted very similar. They're all weighted, especially in the top 10, within a tight band of the percentage of net assets. And you also notice that many of these stocks that are its underlying are very different based on industry. They kind of invest in a variety of different stocks regardless of the industry. Now, if we compare that to JEPQ, you do see some similar holdings, and you also see that the percent of net assets that each of these holdings comprise of is much larger than JEPE. So JEPQ does have similar investment metrics in the way that it's supposed to give the investor income, but the underlying holdings that it holds are completely different. The JEPQ ETF, as you could imagine, is very centered on the Nasdaq, of course, because it invests in the Nasdaq index. JEPI, on the other hand, isn't really tied too much to a specific index. It wants to track as closely as possible the performance of the S&P 500, but it's not trying to necessarily replicate the S&P 500 in its holdings or any specific index like JEPQ is. So you're going to get a high concentration of holdings in the Nasdaq when you get involved with JEPQ. And now that could be a good or a bad thing for investors. You're going to see in a second why JEPQ is going to be good for income versus JEPI, but you're going to see that it, again, is very concentrated. Now, the good thing about both of these ETFs is, again, they are both monthly dividend payers or income payers, so investors are going to get a nice payment during the first week of about every month. Now, the thing about JEPI is that it does offer a yield of about 6.42% currently. And JEPQ, on the other hand, offers a higher yield of about 7.89%. And that higher income is due to the Nasdaq composite basically being more volatile than that of the S&P 500 or the Dow Industrials Index. So, again, going back to the screening method, if we look at JEPI's holdings, it isn't so much reliant on the Nasdaq index. There are going to be some holdings within JEPI that are going to be listed in the Nasdaq, but the overall holdings are a lot less, and again, the percentage of net assets are a lot less than JEPQ. JEPQ does, of course, track the Nasdaq, as I said before, so that volatility is going to show. And what volatility does to options premium is it basically expands the amount that you're going to get in premium when the options are sold. Now, JEPQ and JEPI use exchange-linked notes, which kind of operate more so as a coupon rather than selling options premium, but it's basically still linked to that premium. So as the volatility expands, the amount of income that you're going to receive as an investor is going to expand with that premium. So that means during high volatility environments, you're going to be getting paid more for both ETFs. And now, because JEPI invests in a variety of different industries, you're going to see these industries basically be very similar in a way. So there's really not going to be an industry that really jumps out too much. A lot of these holdings are kind of similar in the sense that they invest in pretty much everything. You're going to see some jumps, but if you notice when we look at JEPQ, you're going to see the main difference. But JEPI is a very diversified portfolio, and that is a great thing for some investors. But if you notice, again, none of these industries extremely jump out. There is not too much of a huge difference between 14.2 and 14.7, or even 11.8 and 11.9. Now with JEPQ, you're going to, of course, just see the immediate jump out because it tracks the Nasdaq. That information technology is the largest portion of the holdings by large. So 40% about is in information technology, and you do see some of the other industries that it holds at somewhat decent percentages, but even if you combine the next highest three, they're not going to be equal to the weighting of information technology. So if you're worried about technology, I don't think that this is the ETF for you. And one of the reasons why I don't invest in JEPQ is because I already have a significant amount of money in QQQ, which is an ETF that tracks the Nasdaq already. So if you're like me and you already hold an ETF that tracks the Nasdaq and you kind of want more diversity, having JEPQ isn't really going to provide you with that much diversity, especially if you already have like tech holdings like me. So if I were to invest in JEPQ, I would just have double exposure to that index, and I don't think that that's very wise. Me, I am a kind of defensive investor. I like to invest in various different industries rather than just have a high concentration in one. So JEPQ is not the ETF for me, and that is why I chose to get JEPI, which invests in all of these various different industries with holdings that aren't so heavily weighted. Now, JEPQ might be right for you if you don't do what I do and hold QQQ already. Like if you are an individual investor and you basically have like a fund like SCHD and you're only investing in that right now currently and you want to have another holding. I did make a video saying that the best dividend combination is SCHD and JEPI. Now, if you, again, want to shy away from the defensive holdings and you want to hold something that will provide you with even more income, there's going to be very little crossover between SCHD and JEPQ. So if you only own SCHD and instead of JEPI you want to hold JEPQ, I don't think that would be a bad idea because there is going to be very little crossover. But if you do hold a lot of technology already, like the S&P 500 or QQQ, like me, then JEPQ probably is not going to be the income ETF for you, in my opinion, because its whole weighting in information technology. You're going to get a good dividend that is going to pay higher than JEPI, but it is not going to give you good diversity at all if you have a high concentration already in technology. So basically, when it comes to both of these ETFs, whether you're trying to figure out how to invest or want to invest in JEPI or JEPQ, I would say that is totally reliant on what you already hold. So if you already hold, again, a lot of technology, JEPQ might not be the ETF for you. Or if you're more defensive like me, you might want to choose JEPI for that diversity in holdings. Overall, there isn't too much of an investment methodology difference between how these funds invest and their intent, as they both do exchange-linked notes. They're both designed to provide income, but there is a large difference in these top holdings here and the overall index that they track and their underlying holdings in general. So that's going to be it for the video. I think that, again, there isn't too much to say about either one of these ETFs in general when comparing the two, because they both kind of are the same in that they do high income, but the only difference is the underlying holdings that they track. Again, if you want to shy away from tech, JEPQ is not the ETF for you. If you want greater diversity, JEPI is going to be the better pick in my opinion. So thank you all for watching, and I'll see you in the next video.